January 1, 2000. Confetti still on the ground, champagne still warm. 70 million American families go to bed middle class and wake up with a plan. A house, a 401k, a future with their name on it. By 2010, the plan is gone. Not the recession kind of gone, not cut back on lattes gone, gone. Retirement, equity, stability, erased. But what if I told you this wasn't an accident? What if the decade that was supposed to build the middle class was specifically, structurally, officially designed to hollow it out? So what actually happened? Cue the vibes. It's 1999 going on 2000, and America is absolutely, irrationally, magnificently feeling itself. The stock market is the Instagram of the decade. Everyone's on it, nobody fully understands it, and the numbers just keep going up. Imagine you wake up in suburban Ohio. Your coffee maker is a Black & Decker the size of a microwave. Your AOL dial-up is basically the Wi-Fi of the era. Slow, unreliable, and you'd absolutely pay anything to keep it. Your husband works in manufacturing. You work in HR. You own a 3-bedroom colonial. You have $80,000 in a mutual fund. You are, by every measure, the American dream in cargo pants. The Dow just crossed 11,000. CNBC is on in the background. Some guy in a fleece vest, the Patagonia of financial media, is telling you .com stocks only go one direction, up. And why wouldn't they? Tech is exploding. Globalization is opening every market. Alan Greenspan is basically running the country from a leather chair, cutting interest rates like coupons. The party, officially, has no end in sight. But this wasn't prosperity. It was leverage. Think of it like this. You're on a first date. The person across from you is charming, beautiful even. You don't know their last name, their credit score, or whether they've ever held a job for longer than 14 months. But the restaurant is nice, and someone told you they're basically a sure thing, so you propose. That's a subprime mortgage. Translation? Banks are now giving 6-figure home loans to people with no income verification, no down payment, and adjustable interest rates buried in page 47 of a document no human has ever fully read. Then the banks bundle thousands of these loans into a product called a mortgage-backed security, which is basically a Jenga tower made of debt, wrapped in a bow, given a AAA credit rating by a company that is paid by the people selling the Jenga tower. And then insurance companies sell protection on those towers without holding a single dollar in reserve, buying life insurance on a stranger's house. And just like that, the entire American middle class becomes the collateral. Enter the American homeowner, optimistic, exhausted, told their entire lives that a house isn't just shelter, it's an investment. It's equity. It's the thing that separates the stable from the struggling. 50 million of them. Teachers, veterans, nurses, construction workers, young couples signing documents they don't fully understand because the loan officer is smiling and the interest rate is 2% for the first 2 years. They are officially the fuel. They don't know they're also the fire. Meanwhile, the rot is already structural. Between 2000 and 2006, U.S. home prices rise 124%. Not because incomes go up. Not because neighborhoods improve, because the loans are too easy, the buyers are too many, and the system has a profit motive to never, ever ask the obvious question. Can they actually pay this back? In boardrooms from Goldman Sachs to Lehman Brothers, traders are literally placing bets that their own products will fail. They're selling the Jenga tower to your retirement fund and quietly betting it falls. Meanwhile, in a suburb outside Phoenix, a nurse named Linda refinances her home for the 3rd time to pay off credit card debt from the medical bills of her uninsured husband. The bank sends her a congratulations letter. In a call center in Charlotte, a mortgage broker named Kevin sells 47 loans in 1 month. Loans he privately describes, in an email that will later be subpoenaed, as, and I quote, a pile of garbage. He earns a $14,000 bonus. Cue the dimming lights. Interest rates rise. Adjustable mortgages reset. Linda's monthly payment jumps from $900 to $1,600 overnight. What could possibly go wrong? Spoiler, everything, simultaneously, for everyone, except the people who designed it. September 2008, Lehman Brothers files for bankruptcy. Not quietly, loudly, catastrophically. $691 billion in assets, gone in a weekend. The phones don't ring, the tickers freeze, the traders stand on the floor of the New York Stock Exchange and look at each other like passengers on a plane that just lost both engines. This can't be real. We modeled for this, we just didn't think it would actually happen. In the next 6 months, the American stock market loses 57% of its value. Not metaphorically, not on paper, real. Retirement accounts for 54 million Americans crater overnight. $13 trillion in household wealth gone. Not monopoly money, real homes, real savings, college funds that become empty folders on a kitchen table in Ohio. Linda loses her house in February 2009. The bank that sold her the loan, the same bank that was simultaneously betting against that loan, receives $25 billion in government bailout money. Cue the static. 8 million jobs gone in 2 years. 10 million foreclosures. The unemployment rate hits 10%, and that number doesn't even count the people who stopped looking. Actually, officially, America is in free fall. But that was just the start. The crash doesn't just take houses. It takes something harder to quantify. The belief that the system is basically fair, that if you work hard, save carefully, and follow the rules, you will be okay. That belief? Officially dead. Enter the bailout. October 2008, Congress passes a $700 billion rescue package for the financial institutions that engineered the collapse. The bill passes on a Friday. By Monday, the bonuses at surviving banks are being quietly recalculated. The auto workers in Detroit don't get a Monday. David, 58, a machinist in Michigan, takes a buyout he didn't want from a pension that's been slashed into a job market that doesn't want a 58-year-old machinist. He applies for 200 jobs. He gets 3 callbacks. Actually, not everyone was blindsided. Economist Nouriel Roubini warned of exactly this collapse in 2006. The IMF held a panel. The room laughed. His nickname becomes Dr. Doom. The people who listened to Dr. Doom, they kept their houses. The system survived. The middle class did not. Not fully. Not the same way. Not one senior Wall Street executive goes to prison for the 2008 financial crisis. Not one. The same firms that required emergency taxpayer rescue pay out $140 billion in bonuses in 2009, the year after the bailout. We bailed out the empire. We foreclosed on the people who built it. The decade that was supposed to be the American century instead produces what economists now call the lost decade. A generation of middle-class Americans who will never fully recover their pre-2008 net worth. Not because they were reckless, because the system in which they placed every dollar of trust was, from the first signature on the first bad loan, running a hustle. They just weren't told they were the ones being hustled. But as the banks stood back up, straightened their ties, and collected their bonuses, something waited on the horizon. The same loans, the same leverage, the same vibes, different decade. Maybe that's why this story keeps happening. Because the crash is the feature, not the bug. And the bill always lands on the same table, yours.